Hello my fellow investors. In this video I'm going to conclude my analysis on Thor. So let me just start off with the first question. If I'm as a value investor, if I'm interested in buying this company, I have two options. One is just to buy and hold. The second option, as a very high cyclical company, I could decide to buy it in a low price and sell it at a higher PE ratio in the future. So the first question we have to ask ourselves is, what's the future for Thor? Can we see this company continue to grow at its pace for the next 20 years? I think yes, and the reason for that is it just now got into Europe a few years ago when they bought Oppenheimer Group, and they hardly even started going into China and all other places around the world. I don't see any reason why Thor can't continue to grow in the next 20 years. So that's, for me, a simple answer. I think so. Well, the biggest question is, I'm assuming we're going to go into recession now. So what I tried to figure out, what's the right price to pay for Thor. So let me just take you back over here to 2006. I made here a few calculations. Now, what I wanted to check was, if we're going into recession now, what could be the future for Thor in the next few years? So in 2006, their net revenue was 163 million, and then we see it declined. 2007, 2008, 2009 was the lowest point with their net revenue of 17 million, which is down almost 90% from 2006. And in 2006, the net revenue was 163 million. It took them until 2014 to get back up to 179 million. So basically, there was a 7-year period, 2007, 8, 9, 10, 11, 12, 13, where Thor didn't continue its growth. Now, when COVID hit, so there's also a huge decline from, in 2018 it was 430 million net revenue, 2019 went down to 76 million, and then in 2 years it was back up. So COVID wasn't exactly a normal financial crisis, so it was something different. And I also checked back the numbers, the data from in 2000 when the dot-com crash. Was also, Thor came back pretty fast. It wasn't so much like a financial crisis, more like a stock bubble, but people wouldn't hit so hard in their pockets like in 2009. So for us, we could take the financial crisis in 2008, 2009 as some indicator what might happen to Thor in the next 7 years. So we can't exactly assume that whatever happened then will happen now, because there's a few differences. One, they had then the bus industry, which they were in, and now they don't have it. So that isn't so much of a factor, since the bus industry they were in was such a small portion of their income. But what the big difference is their debt. They didn't have a lot of debt in 2006, 2007, before the financial crisis, and now they have a huge debt because they bought the Oppenheimer Group. So that could be a big factor, and I wouldn't be surprised if we go into a big recession that Thor might have even for the first time in their history a year which they'll lose money. We could see the interest they're paying now. In 2020, 107 million. 2021, 94 million. 91 million in 2022. You can see the interest they paid back then in 2006, 1.2 million, 774,000, 1.3 million, 500,000. It's hardly anything. And also the capital expenditures. Then the capital expenditures then in 2006 was 30 million, 30 million, 40 million, 5 million. And now the capital expenditures in 2022 was 242 million. So that's a huge difference. A huge company just can't fire all its managers and all its facilities to close down. They can't. It's not like a small company that has only a few facilities and much less managers and much less wages to pay. So I wouldn't be shocked if Thor would actually lose money in the next couple of years. But I'm not saying that can happen. I'm saying it's not out of consideration. So assuming, at least this is a basic educated guess we could try to say, is that what's going to happen now what happened back in 2008, 2009. So what I did was I tried to calculate if I would have bought the company, if I would have bought the stock in 2009 in its lowest, when the stock was very low, and the earnings per share then was 31 cents. How much would I have earned in the next 16 years, from 2009 until if I would have bought the stock in 2009, but going according to the P ratio of 2006, when it was the highest point. In 2006, I didn't know what's going to be. I wouldn't have known what's going to be in 2009, but then it was high. And if I would have tried, if we're looking backwards, then what happens if I would have bought it then by the PE ratio of 2006? So the way I calculated was like this: if I would have bought it in 2006 at a PE ratio of 5, which means it earned $287, I would have bought the stock at $14.50. For the next 16 years, from 2007 until 2022, my yield would have been 547%. The total yield of all the earnings. I'm doing only the earnings, yeah? The net revenue from 2007 until 2022 was $79 for the company. That would have been a 547% yield in 16 years. That's a compound annual growth rate in 16 years of 11.2%. So, for me, that's out of question. I'm not looking to buy stocks that will give me a compound annual growth rate of 11%. If I would have bought the share at a PE ratio of 2.5 of 2006, so in 2006 again, the earnings per share was $287. If I would have bought a 2.5 earnings PE ratio, I would have paid for the company, for the stock, $725. And then from 2007 to 2022, the company would have earned $79.36, which is 1,000%. In 16 years, that's a compound annual growth rate in 16 years of 26%. That's already much better. If I would have bought the company at a P ratio from the high of 2006 with P ratio of 3, which is $8.6, again, same calculation, I would have earned 923%, and I would have been compounding at 21%. Now, I went to check in Yahoo Finance. So what was the lowest day price of Thor in 2009? So the lowest price that came in a single day in 2009 was $9.54. That's a P ratio from 2006 of about roughly 3.3. And at the 2009, when it was trading, that's a P ratio of roughly 31. In 2009, the earnings per share was 31, and $9.54. That's a P ratio of 30, or roughly 31. So if I would have bought it at the lowest price, if I was lucky to buy at the lowest price in 2009 at $9.54, my yield for the next 13 years, that means from 2010 until 2022, would have been... Okay, so if I would have been lucky and bought in 2009 the stock, at the lowest price it traded throughout 2009, which was $9.54, and in the next 13 years, that means from 2010 until the current 2022, the company earned $75.26 per share, which is 788% of total revenue, and which is compounding at 17.2%. So, again, if I would have bought it then at the lowest price, that was a PE of 3.3 of the earnings per share in 2006, and roughly PE of 31 from the 2009 earnings per share. So, if I'm assuming there's going to be a recession, I need to take into calculation, and the most educated guess I can have is that what's going to happen now, what happened then in 2009. So, for now, for 2022, the company earned earnings per share of $20.59. If I want to compound at a minimum of 20% a year, for me that's like a minimum, I have to take into consideration that for next 16 years, it will take the company... If I buy the company at a PE of over 2 of the current price, then I won't be compounding at 20% a year. That's what happened in the last time there was a financial crisis. I put in the numbers. So, assuming there's a recession, I put this all over here. Assuming a recession and net revenue declines 90%. Why I'm assuming it declines 90%? Because that's what happened then. In 2006, the net revenue was 163 million, and in 2009 it went down to 17 million. So I'm assuming the net revenue would go down 90%. And the capital expenditures went from 30 million in 2009 to 5 million. That's a decline of almost 80%, a little bit more than 80%. So if I'm going to take the numbers that they have now in 2022, assuming what happened then is going to happen now, a decline of 90% in net revenue and a decline of 80% in capital expenditures. So the net revenue is going to go down from 1.1 billion to 126 million. and the capital expenditure is going to go down from 242 million to 30 million. And we have an interest payment. The interest payment is not going down anywhere. The debt is a debt and they have to be paid. But let's say now last year they paid 91 million. Let's say they're going to pay only 80 million in interest payment. So we have a big chance of seeing the company earning only $16 million, which is 29 cents per share, if there's a huge recession like happened in 2009. Now, I can't know exactly what's going to happen, and I don't know if the capital expenditure will go down the same way it went down then. Then it was a much smaller company. Now the company is much bigger and has much more expenses, and I don't know if it could go down the same way. I know if their SG&A could go down like it went down then. There's a lot of things I don't know. But my closest educated guess would be that what happened then, what happened now, and probably now will be even worse because there's more debt, there's more interest to pay. The company has more managers that they can't fire, like simple employees they could fire in the time of a recession. There's a lot of expenditures which they probably can't get rid of. So for me, I don't see myself buying Thor in above $40. If it goes down less than $40, I have to see what's going to happen. What's the company's revenue? So basically, what I'm saying is I'm looking to compound for a minimum of 20% a year. I'm not going to buy Thor for more than $40. If it goes under $40, I have to check what's going on with the company. So let me just conclude this part of the segment. If I want to judge by the past, then maybe that's going to be the future. I have to take what happened in the financial crisis of 2009 and assume it's going to happen again now. And if I would have bought the company then at a PE ratio that had in its height of 2006, then I would have been compounding at close to 20% a year if I would have bought it at the lowest price in 2009. So again, we have to check what's going to happen the next year, in the next few quarters. But for me, I can't buy such a cyclical company for over a PE of 2. So now I want to get into another thing. What they bought Tiffin and Oppenheimer Group. Okay, so let's first see what happened with the Tiffin acquisition, and then we'll get into the Oppenheimer Group acquisition. So over here we have from the 10K, the Tiffin Group. On December 18, 2020, the company acquired luxury motorized recreation vehicle manufacturer Tiffin Motorhomes. So how much did they pay for it? So in the beginning, in the first 10K, they said it was approximately $300 million. The actual amount was $280 million and $238,000. How much this was in December 18, so in the end of 2020. And in the next 10K, we can see, actually this was the 10K before that, how much was the net revenues from Tiffin Group in a half a year. So over here they say like this. The result of the Tiffin Group included, okay, this part I want to see. The Tiffin Group recorded net sales of $421 million and net income before income taxes of $11,648,000 for the period from the date of acquisition through July 31st. So basically, in a half a year, the company earned the net sales, net income before income taxes of $11 million. After that, has all different kind of charges. But $11 million in a half a year. So I put this in. So Thor acquired Tiffin at $288 million, and in a half a year they earned 11 before taxes. Net income before taxes $11 million. That's 4% in a half a year. So basically, this acquisition, Thor had a yield of 8% in the first year on this acquisition. Okay, that's not like we showed in the videos before. In the first years, they were doing acquisition with much higher yields. But okay, 8%. But if we go now and check up at what happened with the Oppenheimer Group, that's a totally different picture. So Thor bought Oppenheimer for about $2.5 billion. And over here you can see the income before income taxes this is the European segment, right? So in 2022, the net income before income taxes on the European segment was $87 million. In 2021, it was $160 million. And in 2020, it was 9.8 million, and in 2019, it was they lost 5.9 million on this acquisition. So basically, I put it into yield percentage. In 2019, they lost $5.9 million on this acquisition. That's a minus. In 2020, they earned 9.8 million. That's 0.39% yield on what they paid for this company. In 2021, they earned 160 million before income taxes. That's a yield of 4.6%. And in 2022, they earned 87 before income taxes. That's a yield of 3.4%. This isn't good numbers at all. 3+ years after they bought the company, their yield is 3% on the acquisition. This looks actually very, very bad. This, for me, my first initial thought was this is a big stain on Thor. But the other way to look at it is Thor wanted to become international. And they basically had two options. One is to go to Europe and start building plants and start hiring talent, managers and everything, and do everything from scratch. That would be probably way more expensive, way harder, and way longer than just acquiring a company, a huge company in Europe. So I could understand that Thor understands that to become international and to be a global company, it will be easier, faster, and smarter to pay even a higher price for company, and maybe it will take 3, 4, 5, 6 years until everything gets integrated and everything is managed normally, than just to build everything from scratch. So I can understand this process. Although the numbers look bad, it might make sense. For a company to become a U.S. company into international company, it's a huge process. So I'm not saying it was a bad decision, but the numbers look bad. And the company took a lot of debt for this acquisition. And when we're comparing their acquisition of Tiffin, which they got in the first half a year of the acquisition, 8% yield, and EHG in the Oppenheimer, the first year they lost. The second year was only a yield of less than 0.5%. It looks bad, but I don't know. Maybe it was the right decision. I don't know. Maybe it'll take a few years. Okay, so I conclude my first part where I'm taking into consideration there'll be a recession and what price I'm willing to pay for this company. And then I analyze the last two big acquisitions of Tiffin and Oppenheimer. The next question is debt. I don't see the debt as such a big problem, since they have all the debt is like 1.7 billion. Out of that, 500 million is due only in 2029. The debt doesn't bother me so much. So the next question is, I like to always think, what's the worst case scenario and the best case scenario? So the first worst case scenario would be a depression. If there'll be a depression, and I mean not only a recession but a depression, that would be probably very bad for the company. RVs are expensive things. People don't buy it for so cheap. I believe in a depression, the company would lose a lot of money. So that's, of course, the worst case scenario that comes up to my mind. The second worst case scenario you could think of is what happens if oil prices go up to $200, $300 a barrel. Everyone's, and all these analytics are saying all these different things. For me, I'm not worried about it, and I'll tell you why. If there's going to be a recession, I don't believe the oil price will go up to $200, $300. I think every time there's a recession, oil prices go down. So it doesn't make sense to me that there'll be a recession, and being a big recession, and oil price will still go up. Maybe it wouldn't go down so much, but I doubt there'll be a major recession and oil prices would go up. So if there wouldn't be a recession and oil prices would go up, okay, so there's no recession, so maybe they wouldn't be earning the same amount, with oil prices would be lower, but they wouldn't be losing if there's no recession. If there is a recession, I doubt oil prices will go up to $200. So I don't think this case scenario is so bad. I couldn't think of any other big problem that could be. Maybe if the euro crashes, that could be a big problem with the acquisition of the Oppenheimer group. I don't know. We're seeing now the euro for the first time trading for less than $1. There's a lot of problems in Europe. I don't know. That may be a problem, but I don't know. I can't analyze that. Now, the best case scenario is if there's no recession and everything goes good. Thor could start becoming a global company, going into China, into huge amounts of the world, which they didn't even start scratching that part. So all in all, I conclude this is a very high cyclical company, and I have basically two options. Now, one option is to buy and hold for the rest of my life. Thor's price would need to go really, really low for me to buy it as a buy and hold. I basically have to go down to a P ratio of less than 1 of the last year's earnings per share. And maybe if I go down to $20, I'll be willing to buy and hold. But there's another option. As a highly cyclical company, I can buy the company even if it goes down, let's say, to a P of 20, and it's trading at $40. Even if I won't be compounding at 20%, I can still sell the company, let's say, another 15 years at a high price. We see the price of cyclical companies, they go very, very low and then they go very, very high. Like Thor Industries was trading at 165 until lately. Now went out to $70. So even that, there could be a big nice earnings. Even if I'm not buying and holding, just to buy it and wait for the next cycle to come to its peak. It will be very hard to know when the peak is. But I could just basically say, if I'm buying the stock, let's say at $40, and I'm willing to sell it, let's say another 15 years for $400, let's say, or $600. I don't know what it'll be, but that will make a little bit more sense. Unless it goes down really much. If it goes down to $20, that'll be a good option. If it doesn't go down so much, let's say we're in a peak of recession and the stock price isn't going down under 40, then we still have an option of buying it at 40 and just saying we're going to wait for 10, 15 years and sell it, let's say, at $400 or $500 or $600. Thank you very much, and I hope you enjoyed this video.